I'll be as honest as usual. What we're trying to tackle in this, I would say, session is quite too big to be handled in very short answers. There is no one size fits all. That's the bottom line. When we're tackling government bonds markets and short-term funding for the government is very much different than when we're tackling corporate bonds market and what is needed in that perspective. Yes, there has been some improvement since 2008 and the financial crisis and what happened in terms of clearing and settlement of the different products. But if you ask my opinion, not much has been developed compared to what we were aiming for since 2008 and the crisis onwards in terms of having everything centrally cleared, having the margining. Yes, it improved, but not to the extent that would make for emerging markets their bonds more sellable. Hence, for example, to tackle the issue related to the government side, having the government bonds that are locally issued in terms of the currency being cleared internationally is vital and is very much important. So having it cleared through Clearstream, Euro clearable, whatever, is of paramount importance, and this is not happening or not present much for emerging markets apart from some of the big ones in terms of having their bonds being Euro clearable. And this is very different than the problems that the European Union is facing, because here we're tackling the issue right from the onset in terms of having the product itself being available to different markets. So this is one angle, creating more competition on the trading venues itself. So for emerging markets, it has been mainly confined to what is called primary dealers, either locally or as well from international players. International players, and several requests have been always being put in place that we need the bond to be clearable or being cleared on international or in international clearing houses to facilitate the process of trading and currency convertibility. That is an issue for all emerging markets, especially during the recent crisis in that regard. Streamlining the process of issuance when we move from the government side and having it Euro clearable as much as possible to reduce the potential exposure towards currency risks. When we move to corporate bonds area, there has to be some streamlining. I do agree 100% with what has been mentioned regarding the transparency and disclosure. Part of the transparency and disclosure is to standardize the processes and the information that is being issued by corporates, whether it's a straight bond, plain vanilla bond, whether it's an asset-backed security, whatever it is. However, the more you put in standardization processes and clarity towards what is being issued, this should facilitate the process of issuances for the corporate side, and hence we wouldn't be seeing so much dryness in the markets whenever a problem gets to issue. When it comes to diversifying the products offering as well, is very important for emerging markets. Maybe it's not a problem for advanced ones, but when it comes to emerging markets and the markets whereby they get to sell their products is of paramount importance. We all, most probably all traders and investors know that we have been facing in the Egyptian context some issues until we managed to float our currency again and move towards more market dynamics when it comes to pricing of bonds, pricing of the FX. But before these measures, the market was indeed very dry. Of course, things changed dramatically after some reform measures, but part of the solution was to have a diversified client base rather than focusing on one or two markets in specific, and this should have helped the country or emerging markets to surpass the problem, not having only to rely on one specific market to be obtaining the required funding. So these are the main issues, I believe, that are very different for emerging markets compared to advanced ones, and as well we need to differentiate explicitly between the corporate bonds market and what is needed for them, and as well the government bonds market and the bills market in that regard.
We heard from Jay earlier about the fact that in terms of stress, you do tend to get quite a bit more outflows from emerging markets, from those foreign investors. But we've had some potential solutions, both from Joanna and from Andrew, in terms of what we might do to increase the resilience of markets generally, funding markets generally. Does that align with your view as to what would need to be done to keep the credit flowing to the real economy for emerging markets, or is it slightly different or really different?
Well, Some solutions could be applied, of course, to emerging markets. Some other issues are not pertinent or are not related to market dynamics or infrastructure. Basically, it is related to the macroeconomic conditions of the country itself. So no matter how much efficient you have of trading venues or clearing and settlement rules and procedures, it will still be a problematic issue. But maybe a couple of points that get to help and a comment on private finance markets. I believe private finance markets and its relation to the public markets, we are at the juncture that is more or less similar to private equity and the public markets for equities. There is a regulatory arbitrage, whether we like it or not. The lack of requirements on the private finance markets in terms of disclosures and information, that is for private finance or private equity, makes the public markets at a disadvantaged position compared to those private markets. So what we need to tackle as regulators on the local front and on the international front is how to bridge this regulatory arbitrage. Otherwise, we're going to see that markets and companies will always prefer going to private, finance companies, funds, whatever you name it, rather than going to the complexity of the requirements in terms of disclosures, the prospectus, and how you do it, how you write it, etc., etc. So the moment we start to realize that there is a regulatory arbitrage, we're going to see this migration that's happening from public markets and organized markets to less organized markets in that area. How is this affecting in terms of stability and stability of the funding markets? Because the ultimate beneficiary most probably is the same. You will find whomever is trading in the public markets are insurance companies, pension funds, qualified investors, etc., etc. And the ones that are funding as well, the other type of funds and companies that provide private finance are actually the same. So if we want to tackle it, we need to reduce regulatory arbitrage from the one hand. We need to understand that this is happening and to reduce it from the one hand, and as well to start gathering information. If we are complaining from disclosure and information in the currently public markets, start thinking when a complete migration happens to the private finance, it would be even much tougher than it is as we speak nowadays. For emerging markets and how they can foster and further, I would say, enhance the pricing, let alone, of course, the macroeconomic conditions, and once they are resolved, it is an issue. But again, it would be the product offering needs to be very different, or at least diversified enough to capture different types of investors. But from the other hand, and it's a good venue to see here, to be saying it here, we need to see that investors are really pricing these types of products differently. So emerging markets, for example, they are keen on issuing sustainable related notes, bonds, environmental bonds, etc., etc. But whenever an investor gets to price them, they actually price them as if it is a plain vanilla bond issued by the government, irrespective of its impact on the environment, or if there is a project underlying these types of bonds to finance a carbon reduction, for example. So this component needs to be monitored at least. Let's assess whether this is true or not in terms of yields that are being required. The second step, if it is true, we need to work on differentiating these types of products for the different investors, and for them to realize that by offering preferential rates for projects, that everyone is looking for information in terms of ESG, everyone is looking for projects and investments in ESG and the environment at large to help our combat against what's happening towards the environment. So this component, investors as well need to put basically some seriousness in terms of getting to know what does the product really offer. Is it actually being backed by reduction of carbon emissions, and to reflect this in the pricing of the products.